Let's talk about managing portfolio assets in retirement. I think we will all agree that one of the major concerns retirees have is managing portfolio type assets. While you were working and funding your IRAs and your 401ks, it was easy investing because you were in the accumulation phase of managing assets and there wasn't really much skill to it. You bought shares of various investments by dollar cost averaging through payroll deduction or perhaps on a bank draft on your checking account, which is really a foolproof way and highly recommended way to accumulate. Most of you, as you approach retirement, transition from stocks to bonds for stability, or you use target date funds that made that shift for you. Accumulating it was easy, right? It was effortless. You dollar cost average. But now in the utilization phase, you need strategy to provide the income and spend down your assets if necessary. It would be wonderful if we could just use easy and stable investments like CDs or bonds to provide income. But because we are in and have been in a low interest rate environment, it takes a lot of principle using investments like these. Most of us will need to continue to manage stocks and bonds to create the income and try to maintain our balances through some growth, or at least not spend them down too quickly and run the risk of running out of money. We're going to need to utilize and depend on capitalism and the system of stocks and bonds that supports that great institution and our global economy. The issue, the problem we face, I'm going to call it the 800-pound gorilla in the room that retirees have to deal with, is technically known as sequence of return risk. And it's an ongoing challenge with any portfolio that we need to periodically harvest from for income purposes. It's a challenge because of the rise and the fall and the cyclical nature of all types of investments. Stocks, bonds, real estate, precious metals, commodities, everything cycles. There are a lot of things in life that cycles, in fact. The earth turns every 24 hours. We have winter, spring, summer, fall. The tide rolls in, the tide rolls out. And then the economy cycles. Peak, trough, recovery, expansion, recession. Life is full of cycles, friends. Cycles are a big part of investing, and sequence of returns are greatly affected by market cycles. Here are some examples that will help you to understand the issues that I'm talking about that involve sequence of return risk. Now, in my first example, I'm showing you a retiree who was using a portion of their portfolio in the S&P 500. And I'm illustrating taking income off of that portfolio. And I'm illustrating withdrawing a 6% withdrawal rate. And since the S&P 500 has averaged over 8.5%, historically, it's safe to think that we could sustain a 6% withdrawal rate. So I'm showing 6% withdrawal rate here, and then I'm inflating that withdrawal by 3% to account for inflation. And I did this example in 2019, and so I just used the actual historical performance of the S&P 500 for 25 years prior to that point in time. And look at the bottom line here, friends. This retiree fared very well. They maintained their principal, and they had a little bit of an overage at that point in time, after the 25-year period of time. And so they made the withdrawal at 6%, and they averaged an actual 8.5% rate of return. They averaged that. Now, in my second example, on the left side of the page, all you're looking at there are the same numbers that we just looked at in the last slide. Okay. Now, on the right side of that page, what I'm illustrating is if we had simply reversed the sequence of returns that the actual investor experienced historically. I mean, hey, this is a what if scenario, if you will. What if the returns had been exactly opposite what they were. That's possible, right? The returns could actually have been these returns just as easily. So when we reverse the sequence of returns and we do the math on that, using the same parameters that we used before, well, this investor doesn't fare nearly as well. They actually ran out of money in year 23. Sequence of returns risk are very real, friends. Now, I want to point out too, the average rate of return was 8.5%. The average rate of return here was 8.5%. Now, even though the averages were the same, what the investor experienced was vastly different. Let me take it one step further and show you an example where I can find it. Bear with me, please. So in this example, our retiree retired at the worst possible time. I'm going to call this kind of worst possible scenario, if you will. But this shows the retiree who actually retired in 1999 and what they experienced making those demands on the portfolio. Well, you can see that because of the returns in their first few years of retirement, it was devastating on their portfolio, and they actually ran out of money in year 14. This, by the way, is a good illustration of the folks that I talked about in the first workshop, Jerry and Helen, and what they experienced when the young stockbroker mismanaged their identity and put them into a bunch of real risky stocks at the worst possible time. The bottom line really with sequence of return is that we can't be certain about the sequence of return on any market-based type asset. There's no predictability. A good strategy to help you with sequence of return risk is what I refer to as a bucket strategy. And with a bucket strategy, I divide the money into, in this case, 4 buckets. Each bucket is going to be invested in a different type of portfolio. They're not actually buckets, obviously, they're 4 different accounts. But the point being is the sooner that we need the money, the more conservatively we invest it. Therefore, when markets go down, the money that we need in the short run isn't affected. So that's our bucket number 1, totally safe. In the second bucket, we can afford to be a little bit more aggressive in our management of the portfolio because it's a bit longer term. Third bucket, even more aggressive. Fourth bucket could be all stocks. Point here is that we have separated the money based on the time frame as to when we need it. Now, this can also be a very helpful tool in helping to manage your emotions in retirement. By using time-specific diversified portfolios and not putting yourself into a position of fire-selling assets, you actually manage the threat of sequence of return risk. By avoiding principal, we create significant opportunity. In other words, by not losing, we gain. I also want to recommend that you maintain a home equity line of credit, which can provide you access to stable money at an important time in the event of a downturn in the market and you need liquidity at that point in time. What process do you use to manage your retirement savings? Processes are important because processes provide control. Managing retirement assets doesn't have to be burdensome or a threat. My process can work for you, providing peace of mind.